When you look at silver instead of on this arithmetic or point scale, dollar scale chart, and you put it on a logarithmic scale, ratio scale, going back, again to the 1970s, let's say, and you take the dimension of that range from those, $4 lows to $50 highs, that's a tenfold move from range bottom to range top, range bottom to range top. Tenfold. Okay. Apply tenfold to $50 to match the dimension of that range as a swing objective. You're talking $500.
To accurately forecast the long-term trajectory of the silver market, investors must look beyond standard arithmetic dollar scale charts, which often obscure the true magnitude of historical volatility. A more rigorous approach involves using a logarithmic or ratio scale, which measures price action in terms of percentage growth rather than simple point movements. Historical data from the 1970s establishes a definitive tenfold dimension, characterizing the market's explosive capacity as it surged from a range bottom of $4 to a cyclical peak of $50. Michaeloliver, founder of Momentum Structural Analysis, argues that applying this historical tenfold multiplier to the current breakout level of $50 sets a technically derived structural target of $500. This swing objective is calculated by replicating the exact vertical dimension of the previous major bull cycle. On a logarithmic scale, the distance traveled from $4 to $50 represents a specific quantum of market energy, a 1,000% expansion. Oliver contends that the $50 level, often viewed psychologically as a ceiling, is technically the new base or range bottom for the next major leg higher. By projecting the same range dimension upward from this $50 floor, the charts indicate that a move to $500 is not merely a hyper-bullish prediction, but a mathematical repetition of the asset's established behavior. This perspective suggests that we are currently witnessing the early stages of a massive repricing event, where the market seeks to fulfill its structural destiny by matching the amplitude of its past performance. Now, we present the clips from Michaeloliver's interview. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates. Thank you and enjoy the video.
I think what's happening in silver is different than what's going to happen in gold. I think silver is in a major process of decades of catching up to gold in terms of valuation. We're in a bull trend on silver. Everybody sees it. When you look at daily charts of this, you get spooked like, oh, I got to take profits. This can't keep going, which is stand back and look at a bigger picture and you should get a different view. But in that 50-year, half a century reign price, you went from $4 to 50 to $4 to 50, so you get a $45 range, okay, roughly. And, if you do the simple arithmetic silliness of measuring the dimension of the range and say, well, I'll add that to the top of the range. That says, hey, you're in a target area. It's, $45 range, add 45 to 50, and you end up with something in the mid-90s. Let's call it short of 100. Okay. So people looking at that think, oh, well, this got to be the end of the move. We've done a lot of studies, both momentum, spread relationships, relative performance relationships, and also what's happened in some other markets, rarely, but still has happened. And copper, for example, also this is true with lead, a very exciting metal. They were stuck in a range for multiple decades back in the 80s, 70s, 80s, 90s, 2000, and in 2005 there, you can see there's a cluster of 2004 and 5, but it was later in 2005 that you burst through the top of that basically $1.50 peak that had prevailed for decades. And in a matter, these are monthly, right? Monthly candles? Yeah.
Yep.
Look, in a matter of a couple of quarters, you went up to over $4. Bam. Okay.
Yep.
And by the way, it did it on its own. If you look, for example, at another base metal like lead, it didn't do that then. It did it a couple of years later, the same thing in lead. And this wasn't associated, for example, with a silver gold explosion of that nature either. This was copper on its own. It just said, hey, I'm out of here. That old reality is not true anymore. I'm underpriced. And in order to get to maybe a more proper pricing fit with the new realities of copper, let's say, it didn't do it incrementally. If you weren't there, you missed it. Bam, gone. Okay. And then you lived, you'll see, oh yeah, it was a big sell-off after that. But look at the range that prevailed after that for decades, either side of $3, let's say. So a new reality. Well, how come silver during all this time you're looking at here was contained within its half-century box. It's like copper. If it were still at $1.50 all the way over to the right of your screen, it'd be like, well, why is it still down there? Okay. Why is silver still down there? Gold isn't. If you look at where it peaked in 1980, we blew that out in 2011, big time. Now we've blown out that high big time. And yet silver only just recently has taken out its 50-year range. I'm not going to get involved in the rationale why that may have occurred, but it was an error. Markets make mistakes. They're not rational all the time. And in the case of silver, it's been irrational in terms of being suppressed too long at an unreal price level, especially when you look at its new reality of industrial demand, for example. Forget the monetary aspect, which too many people are forgetting, by the way. But industrial demand has outpaced supply for over 5 years now. And they're not, despite the price rise, they're not increasing production because most of the silver does not come from silver miners. It comes from base metal miners who, in which case the silver they produce is really a minority issue for them in terms of their profits. So they're not extremely motivated by something that's 2% of their output, let's say, going vertical. So it's in a very unique industrial supply-demand awkward position, which it's starting to correct quickly. But when you look at silver instead of on this arithmetic or point scale, dollar scale chart, and you put it on a logarithmic scale, ratio scale, going back, again to the 1970s, let's say, and you take the dimension of that range from those, $4 lows to $50 highs, that's a tenfold move from range bottom to range top, range bottom to range top, tenfold. Okay, apply tenfold to $50 to match the dimension of that range as a swing objective. You're talking $500.
Yep, okay. North of 500.
Yeah, and a lot of people know that, Eric Sprott, for example, I've heard him explain that, if you just do a money analysis of silver price using M2 as your measure of degradation of the buying power of the dollar, silver should be a couple $100 easily, and maybe even higher if you go against the 1980 high. Yeah, you can see what I mean? Yeah, there you go. It's just underpriced, and it's like copper, like lead did in 2006-07, a couple years after that copper chart went crazy. It went vertical in several quarters. It didn't arm wrestle its way higher, exploded. Silver's in that position now. I think silver's like a surfer on the waves, but everybody's focused right now on the supply demand of the industrial aspect of silver. And they're not so much focused on it as a monetary metal, failing to recognize the history that just the same as gold, it's been money for man going back thousands of years, and at much higher valuations. So, if, for instance, if silver breaks out of the price range that it had for 50 years, which it's now done, why shouldn't silver's relationship to gold as a percent of its price, let's say, divide an ounce of silver and an ounce of gold, which is now like 2%, it was 1% early this year, by the way, ounce of silver into gold. But if you go back to the 79-80 bull trend in silver, or the 2010-11 latter part of that bull trend, silver to gold was over 3% in 2011 of an ounce of gold, and it was up 6.5% of an ounce of gold back in the 1980 period. So what if this time, not only does price go up and challenge the highs of the prior decades and take them out, which it's already done, and maybe do the multiple gain we talked about in terms of ratio scale, why shouldn't the spread go up and at least challenge or perhaps even take out those dual highs of the past 50 years? So that alone is a monstrous gain. If gold, and by the way, these surges in silver to gold always occur when both metals are going up strongly.
Yep.
It's never the case that silver goes up and gold goes down, for example.
Silver is currently executing a massive catch-up trade, mirroring the structural breakout seen in copper during 2005. Just as copper shattered a multi-decade ceiling of $1.50 to accelerate over $4.00 vertically, silver is breaking free from a 50-year containment zone. This move is underpinned by a chronic industrial deficit that has persisted for over 5 years, creating a supply vacuum that miners cannot fill. Because the majority of silver is mined as a byproduct, representing merely 2% of revenue for base metal producers, higher prices fail to stimulate new production, leaving the market dangerously inelastic. As this industrial reality collides with monetary demand, technical models forecast a violent repricing. Historical data shows silver peaking at 6.5% of the gold price in 1980, whereas today it sits near 2%. A mean reversion to these previous highs would necessitate a monstrous revaluation, confirming that the current breakout is a delayed reaction to decades of suppression. Let's get back to the interview.
But gold, prior bull markets, the last 50 years have been eightfold gains from bear market low to bull market high. 1976, corrective low just above 100, 850 by 1980. Then over a more protracted period of time from 2001 to 2011, eightfold gain in silver, bear low to bull high. Our bear low was 1,050. I mean, we'd have to be $8,500 just to do the same thing again that we've done twice before. It's like, ho hum, gold did it again, 8,500. Well, if you take 8,500 and figure out what 3+% of that is, or 6.5% of that, your jaw will drop. And I'm not sure at all. In fact, I don't think it will. I don't think gold's going to produce.
What was it, 3.5%? 3.5%, is that what you said?
Yeah, 3.5% of 8,500. You tell me what it is.
$300 silver.
Yeah, okay. And then 6.5%. Back in the 70s and 80s. So
it's like 500.
Okay, you get the point. Okay.
Yeah.
Meaning the logarithmic scale swing objective of silver instead of $45 dimension is a tenfold dimension.
Mm-hmm.
That sort of fits with the assumption that, hey, maybe these spreads are going to actually challenge or take out the highs we've seen in the last 50 years. Not just silver price catch up to reality, but its ratio to gold to catch up to reality. Or in our case, we don't use ratio, we use percent. Think about it. Is it unreal? Does it make sense? Therefore, if that makes sense, then 90-something silver is still dirt cheap. Silver's been in a bull trend for a while, just like in 79 to 80 when it exploded in the final months of that move. It had already been in a bull trend for a while.
Mm-hmm.
Same in 2011 when it exploded to 50. It had already been in a bull trend for years. Something happened late in that move that caused the explosive phase. And what it was our spread relationship versus gold. In each case, I think it was summer of 79, well before that explosion to 50, and in September of 2010, before it launched, it was in the $20 range and shot up to 50. The spread of silver versus gold broke through a ceiling. You plot the monthly close of silver divided into gold, and just plot that chart every month. And what you'd end up with, there was a technical ceiling on the spread. We've had it in our reports many times. And it broke out above it. And when it did, that's when the whoosh occurred. And in each of those cases, just like in that copper explosion we showed, the move came and went in a couple quarters. I'm not going to get specific, 5 months, 7 months, maybe 8. Okay, but let's call it at least a couple quarters, but very rapid. Well, our breakout occurred in November. Okay, the clock started therefore in December. If you ballpark it and say, okay, silver's going to go berserk versus gold and in price for the next couple quarters. So let's say sometime mid-year this year, silver will probably have done much of what it's going to do. And that doesn't mean when it's over you collapse. No, just go to it, get to its new reality.
Mm-hmm.
The spread says so. The history of those prior events, like happened to copper, happened to lead, what happens to gold, it takes out the old highs and goes ape, okay? Silver is likely in the next, starting with December, is month 1, 2, 3, get it somewhere in the second quarter, thereabouts. I'm expecting silver to be at very high price levels, at least 200, probably more like 300 to 500, okay? Now,
second quarter of this year?
Yeah. In other words, the verticality's only begun. Okay. And again, that would merely be replicating what that copper chart, what a lead chart did, et cetera. So you want to be there. And the spread just broke out over a multi-year ceiling. So it's just begun in terms of that relative performance signal. And whenever it does that, there's a gusher, both in net price of gold goes up steeper and silver goes up far steeper because the spread broke out. Silver's unleashed, going to catch up to gold. Maybe it'll go to 6% of gold. I don't know, 3% at least. But it's likely to be compressed on the clock. Now, in each of those cases, we microanalyzed those final surges, 79 to 80, September 2010, April 2011, where silver went up double and a half or quadrupled, et cetera. In the middle of those moves, roughly, on the clock now, middle of the clock of those couple quarter moves, there was what you could call a correction or a stumble or at least a pause. In 79, prior to getting to the January 1980 high, there was not a reversal on a monthly price chart, but there was a pause such that you wasted like 6 weeks in that final surge. You see the little red candle you got there on the monthly?
Yep.
No, the one before you get to the top. That one. No,
this one?
that little guy. Yeah. Okay, so you can see that in October, November, December, there was some lateral action in each of those months where you could have bought and sold it at the same price, meaning there was a pause in the middle of that explosion, which obviously the candle before that was a huge up green candle. And it was followed by what? Another explosion. Similar thing happened in 2010 and 11, if you can move over to that. Again, that's the kind of pause that will confuse people because they'll think, oh, that's the top. Okay, go to 2010 and 11. Okay, there. Oh, see that red candle there? That was a reversal month. In fact, the intra-month high that month was higher than the prior month, and you closed down. So technicians would say, oh, that was a key reversal month, right? Okay, it didn't follow through at all the next month, and it blew your head off. Okay, so again, about in the middle of the clock of that couple quarter explosion, there was a stumble point that no doubt will fool people. So I'm betting probably sometime either late this quarter or early next, there could be a stumble in silver at much higher levels, perhaps, that creates that sense of, oh God, it's a false sense.
Historical data reveal that gold has consistently delivered eightfold gains during its major bull markets, specifically from 1976 to 1980 and 2001 to 2011. Applying this same multiplier to the recent cycle low of $1,050 implies a structural target of $8,500 for gold. When measuring silver against this valuation, a return to the 1980 peak ratio of 6.5% would catapult the white metal to roughly $500 per ounce. Current momentum signals suggest this verticality has only just begun, with targets of $200 to $500 potentially achievable by the second quarter of this year. However, investors must be wary of a specific technical trap known as the stumble. In both the 1979 and 2011 rallies, silver experienced a deceptive pause, or red candle month, midway through its explosive phase, creating a false signal that the top was in. Analysis predicts a similar volatility event, a stumble late in the first quarter or early in the second, designed to shake out investors right before the final, most violent leg of the ascent. Share your thoughts on his analysis in the comment section below. If you find this video informative, please support us by turning on notifications to stay informed about our latest videos. See you in the following video. Thanks for watching.